Okay, so any question before we proceed? Any question with the part 1 previously? Okay. No questions, yeah? If there is no question, just proceed with this one. Just finish with the notes in topic 1, yeah? Okay, going to look at the second part here. It's about the joint arrangement. Previously, in part 1, you learned about subsidiary. Okay, where is my pen? For another color, maybe this color. Okay, for part 1, we have a subsidiaries. Okay, subsidiaries here means that you're going when you have shares more than 50%, and then you are going to have a controls. So we're going to have a controls here means that you need to prepare a consolidated financial statement which is combined parents and subsidiaries items. Okay, and then the next one we're going to look at the joint arrangement. Another type of investment here is a joint arrangement. So joint arrangement, we're going to look at the nature, types of joint arrangement. So normally for the type of joint arrangement, we have two types here. Either that one is joint operation, and then the other one is a joint ventures. Yeah? So details about joint operation and joint ventures, and then prepare for the joint ventures accounts. Yeah? Okay, and then after that, we're going to have investment in associates. So investment in associates here, we're going to look at your investment when you have shares between 20% but less than 50%. So consider this one as a investment in associate. For investment in associate method that we're going to account for investment in associate, we're going to use equity methods. Equity method. But subsidiary last time we have acquisition methods. And then for the joint venture, joint operation, going to discuss later. But for the associates here, we're going to use the equity method. Okay, and then the last part is about the disclosure of interest in others entity, which is related to MFRS 12. Okay. So we're going to look at the instructions of the standard. So the instruction of the standard, the first one is that you have a controls here. So once you have a control, when your share is more than 50%, then you need to follow the MFRS 10. MFRS 10 said that when there is a parent and subsidiary relationship, then you're going to prepare a consolidated financial statements. Okay, so any disclosures here will relate to the MFRS 12. We're going to discuss about MFRS 12 at the end of this notes. Okay, if there is no control, means that when the share is less than 50%, we need to check whether we have a joint control. If we have a joint controls, then we're going to look at the types of joint arrangement. Joint arrangements here, which is referring to the MFRST 11. So for joint arrangement, we have two types, either joint operation and joint venture. Okay, so for the joint operations here, we're going to account for assets, liability, revenue, and expense, and also has a disclosure according to MFRS 12. Okay, and then if there is a joint arrangement is considered as a joint venture, so going to account the investments here in accordance to MFRS 128, which is using the equity method. Yeah, and okay, and also provide a disclosure like the one that are suggested in MFRS 12. Okay, and then if the company do not have a joint control, do not have the joint arrangement, then we consider either they have a significant influence. Significant influence is normally test based on the percentage of ownership. If you have share more than 20%, less than 50, then it's considered as you are having a significant influence. So once you have a significant influence, then you're going to account it based on MFRS 128 using the equity method. So if you do not have a significant influence for the investment which is less than 20%, we're going to account based on MFRS 9, which is like for the investment itself, a normal investment, the one that you learn in your 4-2 last semester. You have a last 2 semester, for investment, you have a fair value through profit or loss, and then the fair value through others comprehensive income. So this is what we have for MFRS 9, and also dealing with the financial instrument also. Okay, if there is no significant influence. No significant influence means that your share is less than 20%. So now we're going to look at these two. The first one is on joint arrangement. The second one is going to look at the joint a significant influence. If there is no significant influence, this one is already discussed in your 4.2 last semester, your financial assets and financial liability, if you still remember that one. Yeah. Okay, now going to look at the joint arrangements. Yeah. Okay, for joint arrangements here is referred to MFRS 11. Yeah, for MFRS 11, joint arrangement is an arrangement was made. Okay, where is my pencil? Okay, for the arrangement of which two or more parties have a joint control. Okay, for example, maybe we only have two, and then they're going to have controls. A and B, they have a controls over a company. The characteristic of joint arrangement. Okay, if there is a parent, we only have one parent. But for a joint control, we're going to have two parties, at least two parties to have a joint control. The characteristic of the joint arrangements here, the parties are bound by a contractual agreement. So the first characteristic, you should have a contract between two bond the two party, and then the contractual agreement give two or more of those parties joint control of the arrangement. Okay, the first one they have the contract, the second one they have a joint control. So just in the agreement it mentions about the joint control. So the joint control here is a contractor agreed sharings of control of an arrangement which exists only when decisions about the relevant activities require animus. Animus here is agreed consents of the party sharing control. So when these two parties join together, they have a joint control. So any decision made for that new business here means that going to need to have should be agreed by both party. Yeah, should be agreed. They're going to agree. Okay, they are going to agree on any relevant activities. So they need to have consent between A and B. Then when they agree, then you can proceed. Okay, with any activities. Okay, relevant activities. Okay, no single party control the arrangement on its own. Okay, there is no single party going to control the arrangement. Means that no A or B can control over the arrangements. Yeah? For example, here we try to look at this example. A and B establish business operation known as ABC. So A and B join together, they come up with ABC. Okay, and then both A and B has a 50% voting right. They have 50% here. This one also have a 50%. Assuming that the contractors are recruitment, so they have the contract agreement, and that in the contract specify that the majority 50% of the voting right are required to direct the relevant activities. So for those who have a right more than 50%, but in this case nobody have more than 50%, means that both party, okay, both party can direct, both A and B can direct the relevant activities. So the question here, you want to decide whether this is a joint arrangements or not. Yeah. Okay, so we need to determine here whether this is a joint arrangement here. The first one, we need to look at the criteria. The first one is a contract. If there is any contract, okay, in the contract, is it mentions about joint controls? Okay, the first one we check. Okay, an agreement whereby two or more parties have a joint control. So the two parties here, A and B. Okay, there is an agreement. We have a contract on this one. The second one, if there is any joint control, it said that the decisions about the relevant activity required agreed consent, unanimously agreed consent of the party sharing a control. So the decision about relevant activity of A, B, and C cannot be made without consents of both A and B. So means that A and B should agree. Then activity in ABC can be proceeds. Yeah? So A and B has a joint control of ABC, right? Because of the two characteristics that they fulfill. The first one, they have a contract. The second one, they have a joint control, means that if they want to make any decision, the decision should be agreed by A and B. Yeah? Okay. So we have types of joint arrangement. So the first one is not structured through a separate vehicle. Later on I'm going to explain what is a separate vehicle. So this one we consider as joint arrangement. The second one is a structure through a separate vehicle. So if that one is structured through a separate vehicle, we need to look at the legal form of the separate vehicle, terms of the contractual arrangement, where relevant, others facts and circumstances. So this one become a joint operation. Yeah. So what is not structured through a separate vehicle? Let's say for this one, A and B join together and then they form C. Okay, this C is a new company. Okay, if C do not have any assets or liability, then we consider that this is a no structures of separate vehicle, no separate vehicle. Okay, this is another example. A and B join together, form C, and then this C has its own assets, okay, its own assets and liability. So this is another thing. So this one is called as a separate vehicle. So this one become a joint venture. If there is no separate vehicles here, means that A and B join together, come up with a C, but C do not have any assets or liability here. So we consider this one as a joint operations. Okay, the next slide is new to you, but this one is only the explanations about the legal form of the separate vehicles. Yeah. Okay, this one is clearly just explain this one. The summary is in here. So the summary is here. If they want to determine whether that one is joint operations or joint ventures, here you need to look at this new company that they form. Okay, A and B join together, they form C. If there is no asset in C and A, means that C do not owns its own asset. Okay, then it's considered as a joint operation. But in this case, if C has its own assets and liability, then this one we call as a joint venture. Yeah? Okay, so you know how to differentiate between joint operations and joint ventures. Okay, so we look at the joint operation first. Okay, for joint operations here, a joint arrangement whereby the party that have a joint control of the arrangement has the right to the assets and liability, has the right to the asset and obligation for the liability relating to the arrangement. Usually no establishments of corporations or separate vehicle. It is not a separate legal entity. It's not separate legal entity. Why is it here? Because it cannot have its own assets and liability. Shares of commons, revenue and expense from the joint arrangement are based on the contractors' arrangements. It means that they can shares, A and B can share the revenue and expense, but how much the shares here is based on the agreements, based on the contract going to be mentioned in the contracts. Okay, this is a type of joint operations here. That for the joint operations here, they're going to share right to assets and obligation for liability and also share for the income and expense. The arrangement established that the party going to share and operate asset together. They're going to share and operate asset together. And how is this to be done? Means that in the contract we mentions about this one. Yeah. Okay, and then they also mentions in the contract how income or output to be shared. If party going to share assets or liability, income and expense in accordance with the terms of the arranged agreements or the contract. Yeah. Okay. Shares of right and obligation for income and expense only. Yeah. Okay, no specific right and obligation for asset. Okay, no specific right. Yeah, on obligations on assets and liability. Each party contribute specific assets and liability to the joint operation or use its own asset and incur its own liability that relate to the joint operations. Means that A and B come up with a C, they're going to use their own asset to operate for C. Yeah? The arrangement established each party is responsible for a separate rules. Each party going to use its own assets and incur its own liability. Okay, the commons here, the commons for the corporate and administrative income and expense are shared based on the ratio or the rates here based on the agreement that are agreed in the agreements. Yeah? Okay, for the treatments here, each party going to recognize its own assets and liability utilized in the joint operation. Recognize its own assets and liabilities here means that in the financial statements of A or B, they're going to have their own assets. This asset, but this asset used for the operations, joint operation. Common income and expense are shared in accordance with the terms of the agreements. Yeah? So to understand this one here, let's say you and your friends want to have a business. So you brought your own asset. Okay, the B also brought another asset. So you're going to use the asset together to operate for the new companies. Yeah? So that is a joint operations. Yeah? Okay, so we try to look at these examples here. A and B enter into a contract to design and construct a roads for a government. Okay, they enter a contract. They are going to bid for the roads for the government, construct roads for the government. So for the purpose of constructing the roads for the government, they set up a new company which is a ZAC. Okay, ZAC going to conduct for the arrangement with the government. So the ZAC going to enter the contract with the government. So A and B join together and then they form ZAC. Yeah? Okay. However, it said that the legal form of ZAC is such that A and B has the right to the assets and liability for the obligation of ZAC based on their participation shares. Okay, means that there is no separate vehicles of ZAC. ZAC's legal form, so this is ZAC legal form, does not allow it to hold assets or to incur liability in its own name. Means that ZAC cannot have assets or liability in the names of using ZAC's names. Yeah? Okay, profit or loss resulting for the arrangement here is shares. So any profit that a loss that are as the output for ZAC is going to be shared by A and B based on their participation shares. Yeah? Okay, so they're going to share A and B here going to share profit or loss from ZAC. Yeah? They're going to share that one. Okay. So the legal form here, the assets and liability in ZAC are A and B assets and liability, means that A and B they're going to brought asset and liability to ZAC. Yeah? So these assets and liability here is owned by A and B. Yeah? There is no separate legal entity. A and B has a right to the asset and obligation for the liability relating to ZAC. So means that all the liability and asset that are in ZAC are is under the right of A and B. Yeah? So for the accounting treatment, A and B each recognize the shares of asset, liability, revenue, and expense based on this participation shares in ZAC. Yeah? So A and B going to broaden assets and liability in ZAC, and then they're going to use the asset together. When the ZAC produce income or expense, then the income or expense is going to be shares together between A and B. Okay. So we try to look at these examples here. Okay, on 1st of January X1, entity A together with another joint operator. Okay, together with another joint operator. So we don't know who are they. Okay, so A plus another joint operator. Okay, they come up with a new company. Yeah? Okay, come up with a new company, separate vehicle to undertake joint operation. Okay, others operators. Other operators, other operators. Okay, come up with a joint operation. The arrangement provided for both parties to have joint control. So all the parties are going to have a joint control over the separate vehicle. So the separate vehicles here, we assume that this one is a joint operation. Yeah? Entity A purchase of property, plant and equipment 5 million for the joint operation. They bought a new PPE. A bought a PPE. So this PPE become A assets, become A asset, and then this A asset they're going to use in a joint operation, going to use that asset. Okay, A bought the asset, that A bought that PPE, that PPE become A asset, and then A decide to use that PPE for the joint operations. Yeah? Okay, and then at the same time, they also borrow 20 million from a bank to part finance its capital contribution for the joint operation. So they also borrow, they incurred borrowing loans here, loans another 20 million. Okay, this loan also going to use for the joint operations. Yeah? Two things that it have here. And then for its capital contribution, entity A has recorded its interest in the joint operations of 30 million, being the amount of cash contribution upfront. So they've also brought 30 million cash. Okay. Apart from the recording its assets and liability in the joint operation directly, A also have the right of 60% shares in the PPE. Okay, 60% shares on PPE. Okay, and then 50% shares on the current asset. Okay, 50%, 50% shares on the current asset, 75% on liability. Okay, and then you're going to have revenue 55%, expense 60%. So means this is the A shares. Okay, A shares in joint operations. Okay, options of A shares. Okay, so now we're going to prepare the journal entry. Before that, we look at this one is a extract of financial statement of separate vehicles. So separate vehicles here is your joint operation. So this is the result of the joint operation. Okay, the results here. So if you look at here, the revenue, the expense that they have. Okay, the PPE that they have. This is in the joint operations company, separate vehicles here, the new companies here. The PPE 160, and then you have 80, 40 for capitals, and then profit from the operations here is your RE here. So if you look at here, A brought 5 only, but means that another 95 is from another joint operators. Yeah? Okay, current asset also, as I mentioned about this one. So this is the outcome or of the joint separate vehicles that they want to produce. Okay, now you need to explain how entity A should account for its interest in the joint operations. Okay, this is your journal entry. Okay, the first journal entry is to record the PPE that you bought. Bought the PPE. The A bought PPE. Okay, A bought PPE. So once A bought PPE here, this PPE become A assets, assets of A. Okay, so that's why you need to debit the PPE set of A. So you're going to debit the PPE and then credit cash. Okay, the second thing, the purpose of this PPE here is you're going to use it. Okay, you bought it in your company, but later on you want to use it in joint operations. Yeah? Okay, the second one, they also brought some incurred some liability for a borrowings here. So you're going to incur a liability once you borrow here. This one become is liabilities. Yeah? Is liability. Okay, becomes a liability. So once you incur a liability, you're going to debit cash, you're going to receive cash, and then credit a borrowing. Yeah. Okay, and then the third one, suppose that you're going to have the third journal entry. Okay, the first journal entry here is to record for the PPE. The second journal entry here is to record for the loan. And then this is the third journal entry. So the third journal entry here is for its capital contributions. A recorded its interest in the joint operation at 30 million. So you need to prepare the third journal entry. So please add this one to your notes. Okay, this is the first one. This is the second one. Okay, the third journal entry can I put it here? Okay, for the third journal entry, you need to record for the cash that you brought to the joint operations. So you're going to credit cash. Okay, cash 30 millions. Okay, and then you're going to debit interest. Okay, please add this one to your note. Interest in joint operation. Here it said that you brought cash. Okay, cash here Maybe you use your own cash another 20 because you have cash from borrowing 20. Maybe you have to add another 10 from your cash. Then you're going to use that one for the joint operations. So you're going to debit your interest in joint operations and then credit cash. Interest in joint operations here means that your investment in your joint operation. Okay, that one will be the third journal entry. Okay, the fourth journal entry is to record for the shares of outcome. Yeah, share of outcome. So shares of outcome here, you need to refer to the statements of financial positions produced by a separate vehicle. So all of these elements here need to time based on the agreed ratio. So agreed ratio here based on the PPE will be 60%, like the one that you have here. Okay, all the items here will be shared based on this one. Okay, right have a okay, so this one will be the shares of outcome. Yes, shares of outcome. So every single item that you have in the financial statements of the separate vehicle need to portions or need to time with the shares of outcomes. Yeah, okay. So for example, for PPE here, the amount of PPE here is hundreds. Okay, from JO, you look at the JO financial statement, joint operation financial statement. Okay, you have 100 PPE. From that 100 of PPE, A, okay, A shares 60%. So proportion for A here will be 60,000. For current asset, the amount here is 60 and that A have a 50% controls or joint control, so you need to time with 50, so you have 30 here. Expand here is 60%. Okay, liability here 75% time with 80, so we have 60, and then revenue 55 time with 100 here 55 here. So if you total up here, if you total up your debit side here, you have 126, yeah. Okay, and then your credit side you have 115. So it means that your debit is more than your credit. So once your debit is more than your credits here, to balance the journal entries here, you need to either debit or credit interest in joint operation. So once your debit is more than credit means that you're going to reduce your interest in joint operations. Yeah? Okay, if your debit is lower than your credit side, you're going to increase your interest in joint operations. Okay, in this case, if you look at here, the debit here is more than your credit. So once the debit is more than the credit here, you go into your reduce your interest in joint operation. So to balance this journal entry, we need to credit interest in joint operation. So credit in interest joint operation means that you're going to reduce that amount. So reduce that amount means that the value of your interest has been reduced, means some sort like that you having a loss here. Okay, so now we're going to check here. I just finished with this one. If you have any question after this, okay, now we need to check for the ending balance here. So the ending balance of your interest in the joint operation, beginning balance, you start with 30, yeah? Journal entry number 3. You start with 30, and then you have reducing in the interest because the interest here is a debit side, yeah? So now it become credit side. So you're going to minus the reducing in the amount of your interest. So 11 here. Now the ending balance here become 19. Yeah? Okay, this is what you have by 19 here. Okay, any question for this example? Okay, you need to add journal entry number 3. If not, then you don't know why the ending balance become 19 here. Okay, any questions that you have for these examples? Please, any questions? Any of you still have questions on these examples? This is about joint of operations. So joint operations here means that A and B joined together. They brought their own assets and liability and use the asset and liability in the new company. Because that new company that they form here, the joint operation that they form here do not have its own assets and liability. So any question for these journal entries? Any of you have a questions here? I think that you have 35 there. Any of you have a questions? You can voice out your questions here or put it in the chat box. I can see parts of that things in the chat box there. Any of you have a questions? Is it okay? Is it okay? Okay, no questions here. So, okay. So since there is no question, this is about joint operations here. Okay, the next one we're going to look at the joint ventures. Yeah. Okay, the next one is a joint ventures. Okay, the joint ventures is a joint arrangement whereby the party have joint control of the arrangement, have the right to the net assets of the arrangement. So they have the right to the net asset. Yeah? Okay, before this, in the joint operation, you only have the rights over the outputs, or the outcomes of the business. Joint operation usually involve establishments of a corporation, partnership or other entity in which each venture has an interest. The venture entitled to share of the result of the joint venture. They are entitled to share the result of the joint venture. Okay, for the joint venture, we are going to use the equity methods. We're going to use the equity methods. Okay, so when an entity prepares separate financial statement, it should account for the investment in the joint venture either at cost. Okay, at cost here, should account it at cost in accordance with MFRS 9, which that one is related with investments here, financial asset. Okay, investment in financial asset, and that or either using the equity method based on the stand 1 to 8. Yeah, either one we have the choice here, but most of the time we are using the equity method for the joint venture. We are using these methods. Okay. So we try to look at these examples. A and B, a real estate company, enter into a contract to acquire and operate a shopping center. Okay, A and B, they come out together, join together, and then they come out with a X. X here is a shopping complex, shopping center or shopping complex. Okay, and then X owns a shopping center. Legal form of X is that X has a rights to the assets and liability, rights on to the asset and liability for the obligation and activity. So now X has its own asset plus a liability, and also they can manage its own activities. Yeah? Okay, they have their own activity, including rentals of retail unit, managing the car park, maintaining the center and its equipment, and buildings, the reputation and customer base. Okay. A and B are not liable for the debts or liability of X. A and B also have a right. Okay, they have a right to sell or pledge their interest in X. A and B only receive shares of net rentals income. That means that they only have a shares in the incomes only. Yeah? Okay, so in this case, when the joint ventures here, the new company going to have its own assets and liability. They're going to manage its own activities. Yeah? So that is under the joint venture. So A and B only entitled for the income, shares of outputs that they have here. Okay, so this joint ventures here is a separate entity, a separate vehicles. Okay, and then so in the separate vehicle for the legal form, there will be separations between A and B with the separate vehicle. So A and B going to separate from X. That is assets in and liability in X are not A and B assets and liability. Means that X has its own assets and liability. A and B have no right to substantial or the economic benefit of assets relating to the arrangement or obligations for the liability relating to the arrangement. Accounting for interest in X using the equity method. So both A and B going to use the equity methods. Yeah? So A and B are not do not have a rights over the asset or the obligations over the liability in X. Yeah? So they are going to account the investment using equity methods. Later I'm going to look at what is equity methods. Yeah? Okay, this is only the summarize here. So joint arrangement, we have two types here. Accounting treatments here, requirements here for the joint operations here. For the joint operation, we're going to recognize shares of asset, liability, income, and expense on line by line basis. So recognize shares or asset and liability here is based on the percentage, like the one that we do for previous example. That one is for joint operation. Okay, for the joint ventures here, we're going to use equity accounting or equity methods here. So the equity methods here also applicable for joint investment in associate with a night subheading, and also applicable for joint venture. Means that joint ventures going to use the same accounting treatment like investment in associate. So in preparing a separate financial statement, they're going to choose either they're going to recognize the investment at cost, or using a financial asset instruments here according to MFRS 9. Okay, and then using the equity methods as so described by standard 1 to 8. Yeah. Okay. So this is what you have for the joint operation. Joint operations here. Okay, you need to differentiate joint operations here. New company, but no assets or liability. Okay, this one new company. Okay, new company with assets and liability. Yeah. So that is what you have, the difference between joint operations and joint venture. And then the accounting treatment for joint venture is similar as you have for the associate. So we're going to proceed with the next one. So this is the done. We already done for this one is related with the subsidiary. Okay, and now we're going to look at this one, joint operations already done. This one done. Joint ventures, now we're going to discuss together with a significant influence, because the method that we use for the significant influence is similar with the method that we use for the joint venture, which is referred to the equity methods. Yeah? Okay. Now we're going to look at the significant influence. So significant influence here is when your share is between 20% but less than 50%. So we said that we're going to have a significant influence. For significant influence, the standard that we're going to apply here is 1 to 8. So 1 to 8 here is referred to the investment in associates. We're going to look at this one. Okay, so joint venture and investment in associate, the accounting treatment is similar, so we're going to discuss that things together, joint venture and associates. Okay, so for investment in associate here and a joint venture, the standard 1 to 8 mentioned that an enterprise with investor has a significant influence, or which is either a subsidiary nor a joint venture of the investor. The criteria used to test for the existence of the associate is a significant influence. We use a significant influence, which is referred to the power to participate in the financials and operating policy decision of the investee, but not control over the policy. We only have a power to participate. Significant influence here is power to participate in financials and operating policies only. Okay, they can participate in this one, but they do not have a control. But they cannot control over that policy. Yeah, okay, they can influence only. Evidence here, so evidence how we can say that the company and the investment is considered as a significant influence. The first one is relate with the representations of the board. If you are the member of the boards of director in that company, okay, participation in policy making process, including the participation in decision about dividends, material transaction between investor and investee, interchange of managerial personnel, and then provisions of essential technical information. Okay, this is we said that we have a significant influence. So 5 criteria that we have here to determine whether you have a significant influence or not. But the most important things that, okay, the most of the time we check for the significant influence based on the percentage of ownership. Okay, normally we are using this one. Okay, this is another criteria number 6. But most of the time we are using this criteria to check whether you have your investment has a significant influence or not. Okay, based on the percentage of ownership interest in the investee is not included in the definition, but it is applied for presumption purpose or as okay. So we're going to use based on percentage of ownership. Yeah. Okay, if an investor, okay, if investor holds, we are using this guideline. if investor hold direct or indirectly through subsidiary 20 or more voting power of the investee, it is assumed that the investor thus has a significant influence, unless it can be clearly demonstrated that that is not in that case. Yeah. Okay, so normally we use a guideline 20% or more is considered as a significant influence. Conversely, if the investor hold directly or indirectly through subsidiary less than 20% of the voting power of the investee, it's assumed that the investor does not have a significant influence unless the influence can be clearly demonstrated, maybe with another 5 items that we mentioned previously. Yeah. So this one is we can check. The first thing we check here based on the percentage of ownership. So when the percentage of ownership is more than 20%, we said that we have a significant influence. But if the percentage is less than 20%, we need to check another 5 criteria mentioned previously. This one, if we have these 5 criteria, also considered as a significant influence. Okay. So the accounting treatments or accounting requirements here, we need to account investment in associate using a equity method. So means that once your share is more than 20%, okay, we consider that this one as a investment in associate. So for investment in associate, to account this one, we are going to use the equity method, except when the investment qualify for exemptions in accordance with paragraph 17 and 19. If there is any assumptions here, you need to refer to this paragraph. When an entity prepares separate financial statement, it shall account for the investment in associate either at cost or in accordance with MFRS 9, relate with the financial asset, okay, or using the equity method. So you have 3 methods here, but most of the time we are using the equity methods to account for the investment in associates. Okay, so in the consolidated financial statement, we are using the equity method. If the asset is held for sales, then we're going to put it investment under held for sales. And then if there is a relate with the financial instruments, we're going to refer to MFRS 9. So MFRS 9 is also used or applicable when the investor chooses to have significant influence. So means that if the share is less than, before this, okay, let's say you have a share more than 30%. Okay, then you're going to consider this one as investment in associate. So you're going to account using the equity method. Okay, let's say after that you dispose. Dispose means that you sell some of your share. Now your investment become 10%. So once the investment become 10%, we're going to record this one as an investment. Okay, investment here either fair value through profit or loss or fair value through others comprehensive income. So this one, when your investment is less than 20%, we're going to refer to MFRS 9. Yeah, we're going to use an MFRS 9. But if that one is more than 20%, we're going to apply MFRS 128. Yeah. So this one we're going to account as a normal investment, yeah, using MFRS 9. Either the investment is a fair value through profit or loss or fair value through others comprehensive income. Yeah. This one is in your 4-2 last semester. You already learned about financial asset last semester, 2 semesters, yeah, in 4-2. Okay. Okay, so we're going to look at this one. For using the equity method, the cost of investments here, we're going to minus the investor shares of net fair value of associate identifiable assets or liability. And then if that one is greater than 0, then we're going to recognize a goodwill. So the goodwill here will be included in as a part of the investments. Yeah? Okay, and then if the investment is the amount that you paid for the investment is lower than the net identifiable asset, so investment minus net identifiable asset, that this one is a positive, then become a goodwill. This goodwill will be a part of investment. We don't recognize it as a goodwill in the income statement, in the statements of financial position. But if we have a negative here means that going to have a bargain purchase. So bargain purchase here is a profit. So this profit need to recognize in your income statements. That goodwill is not goodwill as an asset, but this goodwill we're going to record in the investment itself, and then we don't need to amortize that one. Okay, subsequently, this one is at the date. This one is at the acquisition date. Okay, and then at the subsequently after the acquisition date, so after the acquisition date, investor shares in the investee profit or loss here. If you are okay, so this one is after the acquisition date. Okay, the investor going to have a shares of, they're going to shares the outcomes of investee, outcome in associate. Okay, they're going to have a share in outcome of the associate. Okay, let's say the associate has a profit. Okay, associate record a profit. So when they record a profit, the profit going to increase in investment. So going to debit investment, credit P&L, profit and loss. Okay. Okay, debit profit from associate. Okay, let's say if the company have a loss, associate have a loss, it's going to reduce investment and then going to increase the profit. So you're going to debit loss and then credit investments here. So this is what we have here. So investor shares on investee P&L. So in the case you have a profit, okay, profit here going to debit investment in associate and then credit profit from associate. In the case that you have a loss here, if there is a loss here, so loss you're going to debit loss from associate and then credit investment in associates. Okay, and then another things that affect the company associate outcomes here is a dividends. Okay, when the associate paid for a dividend, okay, associate paid for dividend. Okay, when they paid from the dividend, normally they're going to use their profit. So once they use the profit here, the investments going to be reduced. Because why you need to credit the investments here? Because the profit, we assume that the profit has been reduced. Why profit has been reduced? Because from that profit we use to pay for a dividend. So going to credit investment in the associate and then debit cash. So this is what you need to know. Subsequently, after the acquisition date, anything or any outcome from the associate going to affect the investor. So if the associate produce some income, they're going to increase the investment. If they have a loss, they're going to reduce. If they have an income, if the associate have income, it's going to increase the investment. If the associate have a loss, they're going to reduce the investment. The same thing if the associate paid for a dividend. Because it said why it's going to reduce the investments here? Because the amount of dividend is normally taken from the profit. So when the profit is reduced, it's going to reduce your investment also. Okay, but the journal entry for the dividends here going to be debit cash, credit investment in associates. Okay, so for using the equity method, initially investments going to record at cost, which means that at the acquisition date, we're going to record investment at cost. Okay, the carrying amount after that subsequent, okay, after that the carrying amounts, okay, the carrying amount going to be increased if there is a profit, going to be reduced if there is a loss, and also dividend paid. Okay, two things. Carrying amounts here also adjust for the changes in the investor shares of the component of others comprehensive income. So after the acquisition date, if there are investee or the associate provide changes in the component of other comprehensive income, okay, this one also going to affect the investments. Okay, either that one is increase or decrease in the investment, but this thing should be happen after the subsequent date. Subsequent date means that after acquisition date. So after acquisition date, anything that recognized by the associate also need to be recognized by the investor. So we try to look at these examples. Okay, H acquired 40% of AL. Okay, during year 2018, AL profit after tax is 2,210. So they have a profit. AL here is associate. Okay, H here is investor. Okay, they only have 40%, so more than 20% considered as a significant influencer. Okay, and then during the year, AL associate produce a profit of 210. So we said that profit going to increase the investment. Okay, the next one you're going to have on 30th of September, AL provide an interim report, interim dividends of 30,000 out of a current year profit. So they also paid dividend. So once they paid dividends here, it's going to reduce the investment because it said that the dividend was paid. Okay, dividend was paid using a current year profit. So we're going to reduce the investments. Yeah? Okay, now we're going to account for the profit, shares of profit, debit investment. Remember that this one is going to increase your investment, but based on the percentage. Yeah? Percentage that we have here is only 40%. Yeah? Okay, so debit investment in AL 84, credit shares of profit in associate or associates. So you have 84. Okay, but this one I want you to change this one. This is not dividend income. It's supposed to be cash. Debit cash and then credit investment in AL. 70,000 times 40%. It's refer back to this one. Look at this one. Okay, if you refer to this one, they are using cash. Okay. So the journal entries here, please change. This is not dividend income. Change this one to cash. So debit cash, credit, investment in AL. So dividends here going to reduce the investment because a dividend paid is using from profit of the companies. Okay, the next one, just finish with this one. Yeah. Okay, this is another examples. Same example, but this time we have a loss. Just want to look at the how to going to prepare for the journal entries. Yeah. Okay, assuming that we have a loss after tax of 250. So loss after tax here is going to reduce the investment. Loss going to reduce the investment means that you need to credit your investment. So credit investments of 100 here and then credit a debit share of loss of associates. Okay, so any question with this example? Any of you have a question with these examples? So this is equity method. So for the equity methods, anything that happens to the associate need to be account to the investor also. Need to means that going to affect the investment by the investor. So any questions that you have for this one? Any of you about these examples? Any questions that you have here? Any of you have a questions? Okay. So clear about this one. Okay, the next slide here is only the disclosure. Disclosure, the things that you need to disclose. So disclosures here is relate with MFRS 12. So NFRS 12 is applicable for the disclosure of interest in others entity. So the disclosures here including the joint arrangement, subsidiary, associate and unconsolidated structures entity. Okay, for this standard, we need to follow this standard for the purpose of a disclosure because it provides a comprehensive disclosure standard relate with the interest of an entity whole. For example, in a joint arrangement, subsidiary, associates or others unconsolidated structures entity means that this one is other investment. So others investments will also need to follow MFRS 12. Yeah? So the thing that you need to disclose here, so the entity shall disclose the information that enable user or its consolidated financial statement to understand the compositions of group. So compositions of group here means that what type of investment that they have: subsidiary, associate, joint ventures, joint operations, and another ones you have associate, joint ventures and joint operations. So you need to know what types of investment that they have. Okay, understand the interest that non-controlling interests are the growth activities and cash flow. So we need to provide a non-controlling interest also. Evaluate the nature and extent of significant restrictions on its ability to access or use of the asset. Settle the liability of the group. This one is specifically for the joint arrangement. Yeah? So joint arrangement, who's going to control for the asset? For joint operation, asset is controlled by A and B, the parties. But for joint ventures here, okay, A and B do not have a control. Okay, do not have a control because we assume that the new company is a separate vehicle. So, evaluate the nature of the changes or in the risk associated with the interest. Okay, evaluate the consequences of changes in the ownership interest that do not result in the loss of control. Evaluate the consequences of losing of control of subsidiary during the reporting period. Okay, objective this one, item number 5 and number 6 here is relate with topic 3. Yeah? We're going to discuss detail about this one in topic 3. Okay. Then we're going to look at the disclosure for joint arrangement in associate. So the entity shall disclose information that enable user of financial statement to evaluate. Okay, the first one, the nature or the extent of financial effect of interest in the joint arrangement and associate. So they need to provide the nature, extent, and the effect to the financials. Yeah? Including the nature and effect of its contractor's relationship with another investor in a joint control or significant influence over joint arrangement and associate, the nature and the risk associated with the interest in the joint ventures and associate. So two things that they need to provide here: nature and extent and financial effect, and also the risk related with their interest in the joint venture and associates. So this is examples of the AirAsia. So for AirAsia here, the red one here is a subsidiary, means that you have a control more than 50%. Okay, and then the black one here is associate because you have a power less than 50%. And then the grey one here is joint control. So joint control. 50% means that you join with another joint operators here. Okay, this is examples only. Yeah? How they differentiate between subsidiaries, and the other one they differentiate between subsidiary, associate, and joint arrangements. So this is about the presentation. So the presentations here, if you look at here, we have two companies here, two columns, two columns. The columns for the groups and also the column for company. Groups here is combination between parent and subsidiaries here. Okay, we look at the operatings that we have here for the that relate with the joint the interest here, investment interest we have here. Gain on disposal of interest in the joint venture, impairment of investment in associate, share of result in the joint venture, shares of result in associate. Remember that this one using the equity method. So you're going to have shares of result in joint ventures and also joint result of associates. Yeah? Okay, this is an example for the statements of profit or loss. And then for the statements of financial position, okay, you need to disclose here for the companies here, you need to disclose all types of interest that you have here. So this is the type of interest that we have. So you have investment in subsidiary, means that you have more than 50% control. Investment in joint venture, 50-50, maybe 50-50. Investment in associate, between 20 to 50%. Okay, available for sales here is less than 20%. Yeah? So this is your normal investment, which is related to MFRS 9. Yeah? Okay, this one is related to MFRS 10. This one is 11. This one is 28.28. Yeah? So this is how we're going to present. If you look at in the company sections here, we're going to include all investment, subsidiary, joint venture, associates, and then available for sale. But when it comes to the groups here, when it comes to the group, parents and subsidiary is a single, considered as a single entity. So means that you need to eliminate the investment for subsidiaries in the group section. So means that there will be 0 here. No, because you already eliminate this one. Okay, and then we go, if in a group here, we only have investment in joint venture, associate, and investments available for sale. So available for sale, this one is, since this is the old, quite old, okay, they still using available for sale, but now starting from year 2019 onward, 18 onward, they are using a fair value through profit or loss, and then fair value through others comprehensive income. If the first one is related with available for sale, normally is under fair value through others comprehensive income. They just change the terms for the investments. Yeah. So this is about the presentation or the disclosures. Yeah. Okay, any questions that you have? So this is the end of your second parts of your notes in chapter 1. Okay, any questions that we have here? This is MFRS 12 here is only deal with a disclosure. How we're going to present your investments here in the financial statements. Okay, to summarize here what we learned today. Okay, so the first one we have, we have joint arrangements. Why cannot see this one? Okay. Oh, okay. Why? Can maybe you see. So my pens. Okay, so again, just for the last slide that we have here. Okay, so maybe. Okay, so just summarize what I learned today. The first one we have the subsidiaries here in your part 1, part 1 of your note. Okay, then part 2 you have joint arrangement. Okay, for joint arrangement you have two types here, joint operation and then joint venture. Joint arrangements mean that A and B join together. Okay, A and B join together, then come up with a joint arrangement. So the criteria for joint arrangement, you should need have a contract. Okay, the second one is a joint controls, contract and controls. Yeah. Okay, for joint operations, they come up with a new company, let's say company C. Okay, this company C do not have assets or liability. Okay, and then if that one is joint operation, okay, this company A going to, this company C going to have its assets and liability. So to operate this company C is going under joint operation, they can use, okay, they're going to use A and B assets and liability. But in the case of joint venture, the C going to use its own asset, its own asset. Okay, so that is a joint arrangement. Okay, and then the next one we're going to have investment in associates. So associates here we have 5 criteria to determine the associate, and then the last criteria, the 6th criteria here is based on percentage of share. So that we're going to have when your share is between 20% but less than 50%. So we're going to using the associates, consider as you have a significant influence. So once you have a significant influence, method that we use here is equity method. So the same thing, associate and joint venture, we're going to use the same method, equity method. So joint venture also using equity method. So for the equity methods here, the investment at the acquisition date, okay, we're going to record at cost. Okay, subsequent date, okay, means that after the acquisitions date will be changes in investments due to the outcomes of the associate. Okay, outcome of associate. So once the associate has a profit and the associate report a profit, they're going to increase the investment. If they report a loss, they're going to reduce the investment. The same thing when they pay a dividend, because the dividends here going to they paid dividend using the profit. So once they use the profit, so the amount of the investment going to be reduced. So this is the method that we use here. This is a summary. And then the presentations here is related with MFRS 112. So we're going to look at how we're going to present here. So in the presentation, you need to list down all the investments that you have. Okay, investment type, subsidiary, joint venture, associate, and available for sales. This one is investment which is less than 10%. Less than 20%. Yeah. Okay, and then the rest is this one associate 20%, joint venture 50. This one is more than 50%. Yeah? Okay. So this is about the disclosure. So any questions that you have for notes for part 2 of your notes here? Any questions? Okay. Do you have any questions? Uh, which one? What is the question that you have here? Why the distributions of dividend by joint venture? Huh? Distribution of dividend by JV will increase the parent investment in associate. I can understand your question. What will happen in experience loss? JV. JV. See, cannot understand. Bye. Can you voice out? What is your questions there? We talk
Doctor,
about.
my question, my
Uh-huh.
question is like this.
Uh-huh.
At the equity method at the previous slide,
Which one?
um,
Which part? Which slide you
at
refer
the
to?
at page 25,
Page 25.
yeah,
25 here. Uh-huh. This one.
26, next slide.
Next slide. Okay. Hmm.
Yeah, and we can see that for the equity method after the acquisition date,
Hmm. Hmm.
the distribution of the dividend,
Hmm.
the parents should debit cash and credit investment in associate, right?
Hmm.
So why the distribution of dividend will
Hmm.
decrease our investment?
Will decrease your investment.
Yeah,
Okay, so remember that we have the explanations here. Remember that the dividends here going to reduce. I found this one because once you want to pay the dividends, if the company want to pay the dividends, let's say they're going to use your profit, isn't it? How can they pay dividends? Okay, the dividend is paid based on the profit. Let's say the company have 100,000 profit. Okay, for example, let's say the revenue minus the expense, at the end they have a net profit of 100,000. For example, 100,000. Okay, from this 100,000, they're going to keep this one apart. Okay, as a return profit. Okay, and then they're also going to distribute this one as a dividend. So once you distribute a dividend here, means that it's going to reduce your profit. So once it's reduced your profit, means that the investment also going to be reduced. So okay? Huh?
yeah, understand.
Mm. Okay. Because the dividend is paid based on the profit for the year. If there is no profit for the year, the company not going to pay for a dividend, isn't it? Clear about that one, Bear?
Yeah, clear. Thank you,
Ah,
doctor.
okay. So any other questions that you have? Okay, if there is no questions, can we proceed to the second part of your notes? Not second part, second topic. I just want to have introductions only a few slides, 2 or 3 slides only. Can we look at the second one, the second topic? Okay, can we? Are you ready with that one? With the second topic, the notes on the second topics? You have that one with you? Can we proceed to the next one? Only a few minutes, yeah? Only a few minutes. Where is mine? Okay, I'm going to stop sharing this one, the second parts of your note. Okay, maybe we're going to look at the second. Okay, so I'm going to share with you the second notes. Topic 2. This is your topic. Mm. Now I see you can have this one. Okay. Maybe I just stop this one. Just want to find the notes. Okay, going to share this one once again. Okay. Wait, why is they having this one? Wait. Stop sharing this one. I'm going to find the new notes that you should have here. Okay, I'm going to share this one. Okay, do you have this one with you? The notes, part 2. Sorry, not from the comments. Is it part 2? Okay, so now I'm going to look at the topic 2. Okay, you're having this one. Okay, so I'm going to look at this one. Just a brief introduction only. Okay, details we're going to discuss for the next class because we have a few more minutes only. Another maybe 5 minutes. Okay, we'll try to. Okay, so this one is related with the intergroups company. Intergroups transaction means that this one is a consolidation after. Okay, this is a consolidation after the acquisition date. Consolidation after the acquisition date. In topic 1, we learned about acquisition, consolidation at acquisition date. Now is after the acquisition date. So the thing that we're going to focus here, only the first objective here, maybe the rest we're going to look at for the next class. Okay, for objective here, we're going to differentiate. I just want to focus on this one only. Okay, and then later on I'm going to explain again about this one. We're going to differentiate between pre-acquisition and post-acquisition reserve, because in the reserve here, we have two types of reserve here. Reserve that you have here is a pre-acquisition reserve. Okay, for reserve, okay, you have two types here. Either that one is pre-acquisitions and then the other one is post-acquisition. Okay, for pre-acquisition reserve here, let's use this one. For the pre-acquisition reserve, it reserve that exist at acquisition date. Acquisition date. So parent not entitled for this one or entitled for this reserve. They're not entitled for this reserve. So it need to eliminate. Okay, means that you need to cancel. Okay, this reserve exists in the subsidiary on the date of the acquisition. No distribution reserve by the parents, mean the parents are not entitled, so you need to eliminate in the consideration against COI, again cost of investment. Okay, the next one, you have post-acquisition reserve. That post-acquisition reserve is an increase or decrease in reserve after the acquisition. Okay, include in the consolidated reserve. So you're going to, so once it's a reserve after the acquisition here means that parent entitled. So parent entitled for this reserve. So once they're entitled for reserve, we're going to include in the consolidated reserve. So example for post-acquisition reserve here is a post-acquisition profit, which are profit that are made by subsidiary after the acquisition, and any others post-acquisitions relate with others comprehensive income. For example, revaluations of asset, foreign exchange reserve, and the fair value reserve. So this is more reserve that are exist after the acquisition. So we need to include that one in a consolidated reserve. And then parent entitled for this reserve. Okay, so this is the consolidation process. So the first one, we need to eliminate the carrying amount of parent investment. So we're going to eliminate the COI. The second one, we're going to eliminate the intra-groups, which is going to focus in this chapter 2. And then the third one, we need to account for the NCI, shares of current profit and net asset. Okay, which also in chapter 2. And then the fourth one is to prepare a financial, okay, to prepare a consolidated financial statement by combination line by line items. Okay, so that is a process here. Okay, so this is the one that you have in the examples here. The adjustments here, we need to do the eliminations of the account or transaction are only for the purpose of preparing consolidated financial statement. Thus, it will not affect the parent and subsidiary book. Means that it does not affect the parent and subsidiary separate financial statements. Okay, so this is example. I just want to show you these examples a little bit, maybe 1 minute only. Just want to show on how we account for the reserve here. Okay, so you have here, are you going to proceed with this one? Do you have a class after this, isn't it? Okay, can we just skip this one? I'm afraid that I'm still around. but you still have a class after this, isn't it? Any of you? Okay, so never mind. Can we just look at for the next class? Just want to inform you. Okay, later on for the next class, we just repeat this one again because you have another class. Okay, but I'm free after this. If you have any questions, I'll still be around. But for those who have another class after this, you can leave the meetings. You can leave the meetings there, and then okay, going to meet for the next class. So the next class we're going to continue with the procedure. Maybe we just repeat again what we have in topic two. Yeah? So the thing that you need to do for the next class, just read the intra-groups transaction is more complex as compared to chapter 1. Please read on that one. And then please submit your tutorials, handwritten. Yeah? Your tutorials will be handwritten. Okay, on that 28th of March. Okay, for those who are ready, you can submit that one. Okay. Okay, so see you for the next class, but make sure prepare for the notes for the next class. Just read topic 2. Okay, thank you. Any question? If you have any question, I'm still a bit around. For those who have a class, you can leave the meetings now. Any of you are not yet scanned for the attendance? Okay, I just share with you once again for the attendance. Yeah? Okay, next class we continue with the new topic 2. Again, so we repeat the topics 2. Okay. So 1.5 hours, it seems that it's not enough time for 4, isn't it? How the step to answer joint arrangement question? Step to answer for joint arrangement question. What do you mean by step to answer? Naura? Naura. Can you just speed up? What is you mean by answer for joint arrangement questions? Joint arrangement. Okay, Afza. Okay, Afza. Okay. What do you mean here, Naura? Naura? Joint arrangement questions is that one is joint operation. You just refer to the example that we have here. If that one is relate with the joint venture, similar like the one that you have for associate. Okay. For joint arrangement, this is to answer your questions. Joint arrangement. If that one is joint operation, okay, joint operation, just refer to the examples. Okay. If that one is joint venture, similar as associate, using equity methods. Okay, so maybe the next class you can ask about this one again, Laura. Okay, and only observe them at the rest is okay. Project 1, Drusion. Share option expense are categorized as share-based payment. Can you give example for share option expense? Azawani. Example for share option expense. I cannot relate this one because share-based payment is there is a standard for that one. Which is share options. Share-based payment is any payment that made using shares. For example, you give a bonus to the employee using shares. Uh, Using shares. But this one is share option expense. I don't think that is relate with a share-based payment. Share-based payment is any payments that paid using shares. When you acquire a company or you want to rewards your employees will be with share. Most of the time they use that one for ESOS. If you look at the ESOS, it's more on share-based payments. It's related with the share-based payments. Do I answer your questions, Awani? Okay, check for that one. Normally ESOS. ESOS is a share-based payment. Okay, any other question? If you have any other question, I'll still be around here. Okay, I just want to check for your friends here, the attendance. Okay. Afzal, only Afzal, check for the attendance. Discipline the rest. Going to end the meetings now. Azim, that one. Okay. Izzah. You still have any
Doktor,
question? Yes?
Doktor, if in the statement of equity, of changes in equity, have share-based payment transaction lapse due to resignation, can or not?
Due to resignation.
Ah,
Mean that they rewards the employees. Once the employees going to retire, then they provide them with a shares based payment.
oh.
Okay,
So
means that
cannot.
because
Oh,
actually share based payment is a bonus given to the employee. Some of that one bonus given the employee, maybe to reward for their locally means that they are loyals to the company. They're going to reward either to the existing employees or the employees going to resign. They also provide some shares to the employee, some sort like rewards to the employees. Share based payment.
okay. Thank you, Doktor.
Okay.